Hello traders, it's Samurai Trader here. Welcome to this training session, scalping and day trading fast moving markets. Over the last week or so, we've seen some extreme volatility in the market, particularly focused on the equities market, and these can be extremely dangerous times to trade. However, the market still offers us some extremely good trading opportunities, and we're going to be looking at some of those on the chart. So in this video, it doesn't matter when you're watching it. If you're say watching it a year after the coronavirus scare has passed, this video will still be just as applicable, or should I say the information in this video. As always, these videos or these recordings are raw, real and unedited, so if I slip up on something, you'll have to forgive me. So very quickly, there is a risk disclaimer. There is a risk in trading. If you're reading the disclaimer, please feel free to pause the recording to read the disclaimer. If you're not a current member of the Day Traders Fast Track program, just a very quick advertisement, I should say, if you're not a member, please click on the link below and request my free ebook, The Truth About Day Trading. Make sure you also subscribe to my YouTube channel, and you can also request a copy of my free training manual. Actually, not even request it, you can go to the website and download it from there. So moving right along, I've got I think it's over 7,500 members now, and I've got over 200 coaching members, and I talk about this all the time. Success is never due to one thing, but failure can be. And particularly in this sort of market where we're seeing extreme volatility, and traders suffer from what we call FOMO, fear of missing out. Traders, if you've got one market that's extremely volatile, there are usually other markets that are very tradable. I'm going to give you some alternative markets to consider. It's not only just your trading account that can take a real dent in these markets where they're extremely volatile, but it's also your confidence as a trader, because what we're experiencing right now is extreme slippage in placing orders. But not only that, if you get stopped, it's not uncommon in an incredibly fast moving market to get 3, 4 or 5 ticks slip past your stop loss. So it's just not getting in, but it's if you get stopped out, and that can certainly hurt you as well. Now typically, if we look at this chart here on today's volume, and I'm not going to give you today's date, because once again this video is ageless. It doesn't matter when you watch this. This is the information I'm giving you is exactly the same in any fast-moving market. The ES today turned over 3.5 million contracts. Now typically the ES will turn over around 1.5 on an average good day. So we can see here we've got some extreme volume, and what usually comes through a volume, particularly on the equity markets, is volatility, where we see some spikes. We see the market really flying, which means slippage when we enter a trade, very hard to get in, perhaps on a limit. You might be able to jump in if you've got a buy stop or a sell stop well in advance, but they're difficult to trade. The bond nearly 2 million, and actually it would have hit 2 million. This screenshot I took was 45 minutes before the market closed. We go down here, the Euro Stoxx 50, even you look at the NQ, the micro contract, and we've got around 1 million contracts. So we've got a lot of volume. We go down to the 10-year note, one of the markets that is still tradable, and we're going to be looking at the charts in a few minutes at some of these. 3.1 million. However, the 10-year note and CL are a couple of these markets that still remained tradable. So we'll look at these closer in a moment with some further suggestions. Now in a normal situation, what I tell my traders is we have 3 different markets. There are really 3 different trading sessions. We've got the New York session. Generally speaking, that's where we've got the most volatility and the most volume flowing, except for FOREX, where the currency markets, where you're looking at the London session. But generally most markets are focused on New York. And when we roll over from New York into the Globex session, which is actually the Asian session, you've got to really get used to the market slowing right down. But the advantages of that is you can have or use a smaller chart size, which means a smaller stop. So there are advantages in that. Then from Asia we then lead into the London session, where our volume will pick right up again. But what we've been experiencing is really the last week or so, the last 24, or during each 24-hour period, all sessions have been extremely volatile and difficult to trade. So when we're day trading and scalping fast-moving markets, we've got a few considerations. First of all, do you even trade at all? Are you better off taking a few days off? And this is where FOMO comes in, and it's very difficult for most traders. The market's always going to be here next week, the week after, and next month, and that's one of the greatest challenges. However, if you're open-minded, there are a lot of other markets that are still very tradable, and we will be looking at those in a few minutes. Now certainly we can increase the time frame, but there can be some drawbacks to that also, such as increasing our stop losses. That is, if you like to tuck your stop, say under the closest little swing low or swing high, and you're trading a higher time frame, that means a much larger stop. And one of the challenges there is, are you staying within the risk parameters of your trading account? Stand aside, take a break for a few days, trade an alternative market. So here are what the main concerns are, or main considerations I should say. First of all, which market is it tradable? So what's my definition? Is it tradable? My definition is that you can trade, if you're say used to using a limit order or a buy or sell stop, that you can still do that. But some markets, when I say they're untradable, they take off so quickly. And say if you use an EMA bounce strategy, you might be 10 ticks away before you even blink. That makes it not tradable. And also it's not tradable if it's no longer within your account size limitations, that is within the 2% risk rule. Now what other considerations can you make, or what markets could you consider? Well, right now if we look at the equities markets, which are particularly extremely volatile, even though CL, the black gold, the Texas T, has been dropping in price and there's been some volatility, overall 90% of the time it's still been very tradable. We're still using the same tick size candles, the same Renko candles, etc. So that is still a great alternative. Now for our ES traders, if you've never traded CL, ES is $12.50 a tick, where CL is $10 a tick. So it's not a big difference, very similar, and I personally believe you get much smoother waves in CL either way. Now the next one is the 10 and 30-year note, and particularly if we consider the 10-year note, where I believe, and where I really believe it's better than the 30-year note, you get better waves, better trends. Even though we've seen some extreme, a lot of volume pumping through 3 million contracts a day, 99% of the time it's still also been very tradable at $15 odd a tick. It's perhaps a little higher, but if you're looking at a 4-tick stop on average, it's still not too bad. Then we look at the currency futures and the Forex market, the currency markets. EC, and we'll have a quick look at that, also has still been very tradable. So it's really time that you did consider other markets. And I think Richard Dennis said this many years ago: read the setups that you use, traders. If you're trading a market where the strategies that you use on that market you cannot apply to any other market, well, perhaps you shouldn't be trading that strategy. And I tend to agree with him. No matter what strategy you have, it should work on any market. Now the next key consideration is the broker margin requirements. Now most margin requirements that come out have been outlined or are required by the CME. So the CME will contact your broker, particularly when it comes to the futures markets, and say, here are the margin requirements for these contracts. And of course the day trading rates or the margin requirements have gone through the roof, and so have the overnight margins. So if your broker offered overnight margins, you'll find that they've gone up considerably because of the extreme volatility. So re your account size, you do need to consider that. So CL has remained relatively good in that sense, and so has the 10-year note. Now we consider the chart type. Now when it comes to trading traders, and if we look at the major charts that are used, we've got the time-based charts. Now the challenge with time-based charts, if you're used to say trading a 5-minute or a 10-minute bar, they're huge, meaning that if you wish to say place your stop loss under the closest swing low or swing high, or even under your entry candle, you might be looking at a 20 tick stop. Okay, you're looking at a massive stop loss. So this is where you really want to look at lowering the time frame, even right down to a 15-second or a 30-second, which I'm going to show you as well. See, one advantage you do have with a time-based chart is at least you know when the candle or when the bar is going to close, and so that's a really good advantage. Now I know with a tick and a volume and I believe you can even get now a Renko indicator that will show you where it's going to close. So and we can estimate or guesstimate where it's going to close and put in a buy stop or a sell stop. However, in a fast moving market, that makes it very, very difficult. For an example, I use a tick countdown timer, and that's great in a normal market. So say on CL, where I've got a 233 tick countdown candle, I can see it ticking down, so I can be prepared to enter a trade just before it closes or as it closes. However, on the ES, where I'd normally trade the New York session with a 550 tick, it's gone. I mean, in seconds we've flung straight through it. So that's very, very difficult. So we need to either increase the time frames on these, okay, or use time-based, or once again look at alternative markets. So time-based sort of has a heads up, but you'll still see in a moment that you can still have some real volatility or very large candles even on a 15-second or a 30-second candle. So the next thing is our time frame, which we pretty much discussed, is that the larger the time frame, generally the larger your stop loss. So that can be a real concern. So you just need to look at that. Your entry point, of course, if you use EMAs or say moving averages in your trading, what we generally find is the further the market moves away from your major EMAs, the more likely you are to have a snapback to the EMAs. And so what we're finding is that you can pick up easily 4 or 5 tick slippage from a normal entry. So already you've ran right out from your EMAs or moving averages, whatever you use. Might go a little further, then you get that pullback. Okay, so this extreme volatility can be quite challenging even for your entry. And with your entry, what type of market order do you use? Do you go to market, where a typical market order in a fast moving market maybe even 4 or 5 ticks? Even on the ES we've been seeing that in the last week. To use a limit order, it's been near impossible. It's moving that quickly. So we do need to then consider a buy sell stop, which in a fast moving market, by the time you get it on, unless you're well away from where price is sitting at the moment, it can be very difficult. So these fast markets can be really challenging. So we've got to consider that slippage issue, not just on the buy sell, that's not the issue, but on the market orders. Now the next one is our stops and the 2% rule. I recommend to all traders that you never ever and you never break the rule of having more than a 2% risk factor. The lower the better, and as you build your account size, you want to drop that down to 1% or even lower if you're trading a very large account. Now even if you've got a stop loss in place with the 2% rule, we've still been witnessing 3 and 4 ticks slippage if it goes against you. That's right, just because you've got your stop in place doesn't mean price is going to go smash through your stop loss and you get slip. You need to remember that. Okay, so don't be surprised if you're seeing that. So on and you know, we're looking at trading platforms like TradeStation, which I use, members use NinjaTrader. They're being what I call choke with the amount of data that's flowing into them at the moment, and so we're experiencing time delays or lags in execution, and then we get slippage, and it goes on and on. And then we've got issues with our targets as well, because if we're getting in late, it just goes on. So traders, it's very difficult trading fast moving markets. But there is some good news, and it's this: there are some markets that are very tradable. Let's start off with, first of all, looking at the ES. Now what I've got here on the left is an ES chart, 15-second, a 1 minute, and a 3 minute. So we can see I've got my countdown timers. Now my countdown timers, I've got two different types. Don't allow me to go by the second. That is, yes, it'll tick down from a 1 minute chart, but it doesn't work on, say, a 15 or a 30 second chart. So time-based charts are still there's still some advantages to those on the basis, and we're in the Globex session I'm recording this, so let's just go back to the New York session. So here we go. All right, so if we look at some of these moves, though, look at this 2 4. So you're looking at that's 8 ticks, 2 points, just in that sort of little move just there. Now when you trade a fast market, I know you can trade the breakouts. Okay, so here if we looked at a fractal break, you've got one there, you've got one there, you've got one there, you've got one here, you've got one here, and you can be swept into the market. And yes, if you're quick enough, and you've actually got, for 15 seconds, you've sort of got on average about 30 seconds to 1 minute to put in a sell stop order or a buy stop. If you trade fractal breaks, you can, you've usually got time to put in a sell stop or a buy stop. The one thing you can also look at is that once it starts, and once you've got a good solid trend and you're trading what I call full candles, you're usually being swept with the trend. Okay, so here it's very hard when you get this sort of move to lose. That is, if you're trading with the trend and you've got a sufficient stop. Okay, like just there, we would have about a 10. I'd say, let's have a look. We've got the low of that is 1250, the high is 15. Well, there you got it. That's 4 points. Okay, that's 16 ticks. That's $200 stop if you use that. Now the red dots here are my ATR. So yes, you can use an ATR and have your stop at the ATR. So it's still quite challenging. It becomes even more challenging is when we hit a choppy zone. Just want to show you all the good areas. Let's look for chop, because when we start to get into these can be some of the challenging areas. Let's have a look here. As you can see, there's lots of good areas, but it's these challenging areas that can be the account killers. So first of all, this is a consideration that you look at a time-based chart. Now, as I mentioned, we are in the Globex session right now, so let's have a look at the 2-tick Renko. Let me expand this. I've got my I call this my entry chart, my anchor chart 1, anchor chart 2. And members, you should be familiar with these by now. If you're a member of a public watching this, you can trade with one higher time frame if you wish, but it becomes very powerful when you do introduce an anchor chart to your trading. So if we look at this right now, from there, that's 2053 right over there, 2053, that's 2119. So we can see here in 22 minutes on a 2-tick Renko, this has been the price action in that time. Now generally speaking, during the Globex session, you'll find you can trade a 1-tick Renko most of the time, and we can see here that a 2-tick, you've got to be really nimble. So one of the key considerations in a fast moving market, also traders, is really this, is to make sure that you're trading with the trend. Yes, you can still do very well with your T3 type trades or your divergence type trades once you know your stuff. However, for a newer trader, or if you're not consistently profitable, I really recommend that you just look at your anchor chart and make sure that you're executing trades. These are your divergence type trades when you get down here, but just stick to trading with the trend. There's a ton of trading opportunities in fast markets. Now for the members watching this, we can see here we've got a great ABC there, you've got a lovely trade there. Here is a typical divergence trade right here. Okay, so let's just have a look at that one. Let me just quickly click here and let's just see if that was a 2D. Let me just do this. Okay, now that within itself was just a T19. So members watching this, that was a standard T19. But what can you tell about this move? A key consideration, traders, is that when you trade, is that if you're considering taking a divergence trade, is how many time frames do I have divergence on? Well, here I've only got divergence on the lowest time frame. The next key consideration is, do I have angulation? Look at the amount of angulation from price action angling away here. Can you see that, the big V? That's what we call angulation. The next consideration is, if I was to enter the market, and in this case I enter on the close of my third candle, I know they're bricks, they're Renko, but I call them candles still. Have I got enough room from my entry to the 34 as a minimum to take a profit? It's a big yes in this case. So in other words, this is a great trade even though I've only got divergence on one time frame. Now it also tells me, traders, that when you have angulation like this, if you get another bounce or an EMA bounce here off your EMAs like we did have here, that many of these will fail. This is profit taking, then it will continue back in the direction of the trade. So in looking at this, and let's just go back a little more on the 2 tick, whoops, just go back a bit further to the Globex session. Where are we here? There were some opportunities, but it's mighty fast. Let's now have a look at CL, the black gold, the Texas T. So if we look at black gold, this is 21.30, and what time we got there? This is 22.21. So this is in the last 50 minutes of trading, and let me just perhaps expand this out for you a little easier to see here. So what we can see here is trading with the trend. There's still been some great opportunities. So let's just perhaps analyze, just analyze. Okay, so we can see here, bang bang bang, here are our classic trades. So members, you got your rule of ones, you've got your 34s. We come up here, no doubt you would have had right there, you've got a bounce off the 50% level, then you form a beautiful T7, and that also, traders, would have been a 2D. When you've got a 2D, where do we target? The 89. Now when we look at that, let's just check the timing. 2001, 2001, 2003, that was over 2 minutes, and then you've got a nice ABC setup. Thank you very much. All right, and that there, traders, if you're using a higher time frame, would be an ABC setup pulling back to the 78% level on your anchor chart 2. Okay, here is a classic 2B, here is another classic 2B. So what we can see here during the Globex session, there's a ton. Look at that angulation. All right, look at that. That is a trade you'll take every day of the week. So that's a 2 tick Renko, which is too fast when you're trading the CL during the New York session. So during the New York session, we generally trade a 4 tick Renko. So if we look at the 4 tick Renko, which I've got up here, and we look at the Globex Open, okay, so this is the Globex Open right just here. Had a beautiful 2D pivot bounce right here. That's a 2B. You then come up, you had no doubt that was probably a 2D, but either way you can see our rule of one entries. We then get another bounce here off the 50 cents and we come down. However, what I really wanted to show you was New York. Now during the New York session, there were still a ton of very tradable trades. So this is 11:30 in the morning. Just really, it doesn't matter really what we look at. And once again, you can ignore the CT trades if you're a new trader. I'd really recommend you sit those out initially. But okay, nice winner. Um, uh, uh, Look, and by the way, traders, you can argue that yes, anyone can look back in hindsight and say that they're easy to see. However, let's go to the right hand side of the chart for a moment. Okay, so we've got a concept and we call it get ready, get set, go. So if you're trading, say, a Renko chart, it can just be easier. Let's just do it here on the Renko. Here's what we do. We see price action pulling back. When you see price action pulling back, particularly on a deep pullback, I do want to see for a trade entry to qualify, I want to see 3 higher closes. So when I see a trade pullback, say to an 89, this is the time where I'm getting ready. However, what we do know is that the first pullback after a 2D or a T19, about 50% will fail. So this is a very low probability, where a 2B in normal conditions here, these are all 2Bs. I won't go into them right now, but they're all winners. So we do know that when they fail and they're plain vanilla. So when we see price action pulling back, let me just do this. I'm just going to turn off my white paint bar because it's going to. Okay, so what I'm looking for here is as we come back, and in the coaching sessions, as I say, traders, what are we looking for? We're coming back to what? The pivot. We've come back to the 200, and we've also come back to the 46 a barrel. So what do we expect of that level? A bounce or a reversal coming back. So what are we looking for? It's our first green candle. There it is there. So we have a signal that says get ready. Second green candle, get set. Third green candle is a go, always on 3 higher or 3 lower closes. If you're a non-member watching this, there are a number of other conditions, of course, what's happening on the anchor charts, but they're rules-based strategies. But what we can see, traders, that's over an hour there. In that time frame, there were a ton of great trading opportunities. So 2Bs, as we know, 2Bs, if we look at those, 2B, and there's one just up here, all winners, are the highest probability trade we have. But then we've got our 34Bs and our rule of ones, the kick butt. Okay, so we can see here, whilst the ES was very untradeable, there were some great opportunities on CL. Now let's have a look at the currency, at the euro currency, which is $6.20. And by the way, if you're not familiar with CL, it's $10 a tick. So what we can see here with the euro currency is at 6.25 a tick. I'm just looking at a 1 tick Renko. So, and let me expand it for us. Okay, so first of all, let's have a look at that move just here. 14, 23, 44. See how long that took. See that there. Okay, now that is what we call a T3 or a snapback. That was over minutes. You had a ton of time to get ready. Now if you don't like Renkos, you can also of course use the tick chart. You could use I'd be recommending during the Globex session maybe a 55 tick. Okay, and you can see here if you if you were scalping for 4 to 6 ticks, remember you can trade the tails and you can trade your rule of ones. And we come down here and look at that angulation, traders. Look at that. Then we had our typical ABC setup. We had our typical, that would have been a 2B, and what have we got here, traders? It is a 200 overshoot. Let's have a look and see what it's telling us on the anchor chart 1. Lo and behold, what is it here? We've got on the anchor chart 1 you've got a pivot bounce, but on the anchor chart 2 you've got a 289B. Okay, these are trades that are pattern based. We see them every day. But now I'm getting carried away here. What I want to really get across here is that the euro currencies are very tradable. Let's now have a look at the 10-year note. Now mind you, we are in the Globex session right now. Okay, so since the Globex open, actually this is good to show. Okay, so it's been open for 4 or 5 hours now, and this is the entire action from the 10-year note in that time, and it's 1562 a tick. Now we can see from the open we had a nice little ABC, then we had some beautiful 34s on the way up. What about during New York? Now remember, we turned over 3 million contracts today. Okay, so you're going to have a look at your traditional trend following. Okay, so we're only talking about trend following here. You had a trade, you had angulation, stopped on that one if you took that one, and you may remember most of these will fail. It turned into an ABC. You had a trend, you were stopped if you took that one, on that one, then you had a nice little winner. Okay, so following the trend, unless you get extreme angulation with great divergence, and let me just see what we had on that one. Let me just see there. Yep, looks like it was just a T19, but look at that angulation once again. So what I really wanted to get across here, traders, was that even in fast-moving markets, there are still some great trading opportunities. But what you've got to do, traders, you've still got to be extremely cautious. Find a market where it's what I call tradable, a market that's within your risk parameters of your trading account and your level of experience. So thank you, traders, and I certainly hope you picked up a few ideas and tips from this video.